Good afternoon, everyone. Thank you for joining us for today's webinar, 2020 State and Local Tax Update. My name is Mark Heath. I'm Partner and Director of Tax Services here at McConley and Asbury, and with me today is Lindsey Waltemyer, Tax Manager and leader of our SALT group. If you have any questions for us during the webinar, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. Also, very important for many of you out there, there will be 3 polling questions during today's program. So be sure to answer those if you are looking to get CPE, which I'm guessing many of you are. We will try to make a lot of noise when those questions come up so you know when they are, so you can chime back in case some of you are just here to get CPE, because we keep it real here at McConley and Asbury. We know that's why some of you are here. So, little bit quick about McConley and Asbury. For those of you who don't know us, we have 3 offices here in central Pennsylvania. Our main office is in Camp Hill. We also have an office in Lancaster and in Bloomsburg. We are a full service accounting firm specializing in many different industries, including affordable housing, construction, employee benefit plans, family-owned businesses, nonprofits, manufacturing and distribution, and healthcare. If there's anything you think we could help you out with, we would love to hear from you. Just give us a call. All right, now let's get on to our content for today. Outline quick of what we're going to be talking about, and Lindsey's going to do most of the heavy lifting here. We're going to be going over the Federal CARES Act. We've spent a lot of time talking about the big item in the CARES Act, the paycheck protection loans. But today we're going to be focusing on the other tax aspects of that and the state treatment. Many of these items have not been really addressed too much yet because we've been focused so much on the paycheck protection loans. There's a lot of changes here as it relates to states and how the states are keeping up with that. And forgive Lindsey, this is the first time that she's been in charge of advancing the slides on the webinar. If any of you were with us on our paycheck protection loan webinars, you saw how much Dave and I fought over trying to figure out how to advance these slides. Believe me, it's a lot harder than it looks. So, but other than that, outside of the state treatment of all the things in the CARES Act, obviously most of our attendees today are in Pennsylvania, so we're going to be talking a lot about Pennsylvania and the pandemic-related updates there, and the ever-popular Wayfair case. We're going to revisit that and see how states have updated their guidance and how they're handling that. And then just some general state tax updates from across the country, big changes in any big changes we see in state tax landscape there. So with that said, I'm going to turn it over to Lindsey. Take it away.
All right, Mark. Well, that is strike number 1 on the slides for you, but we will continue. As Mark mentioned, first we'll talk about the CARES Act in general. And in order to do that, I think we need to start off sort of in a federal context. Mark's already been on several webinars about the CARES Act and the PPP loan, so I'll defer to him on some of the federal provisions. But before we even get into that, I wanted to talk just a little bit about conformity to the federal code and how that relates to how the states are going to tax items. So you've got a few different types of conformity. First off, the main 2 would be fixed and rolling conformity. And really what that means for fixed conformity, you're saying that the state, whatever state you have in mind, is conforming to the federal code as of a certain date. So, you know, they pick a date, they decide they're going to conform, and that's what they go off of. Then whenever there's federal tax reform, the state has to update that date before they will conform to any of those federal changes. On the opposite side of that, you have rolling conformity, which means the state is going to conform to the most recent federal tax code. So they don't actually have to make a change when federal updates its tax code because the state will automatically conform. And then finally, we have the difficult states that decide they want to do select conformity, and essentially that is picking and choosing what they want to conform to. And Pennsylvania happens to be one of those states. So jumping into it, our first topic there is the economic stimulus payments. As many of you know, this is the $1,200 or $2,400 you may or may not have gotten from the government, had Trump's signature on it. So for state purposes, well, I believe the IRS has already stated that these are not taxable, but for state purposes, Pennsylvania has also stated that these payments will not be subject to PA taxes. And Philadelphia has also stated that these payments will not be subject to Philadelphia wage or earnings tax. So at least something you don't have to worry about in that regard is taxation on those economic stimulus payments.
And one point to that, we're still trying to figure out how those stimulus payments are going to be treated going forward, because technically it's being classified as a rebate of your future taxes. And since you don't get a reduction or a deduction from state taxable income for your federal tax liability, a rebate in that liability should not be income. So I would be surprised if any states came back and said this was actually taxable, because I think they would have a legislative problem if they started doing that. With that said, it's great to hear that Pennsylvania and Philadelphia have both come out and said it, just to eliminate any confusion.
Yeah, absolutely. It's always good whenever we have specific guidance on any of these items, just because it clarifies, there's always going to be something that somebody is questioning. So with that, Mark, if you want to talk a little bit about qualified improvement property and the federal rules on that.
Yeah, so qualified improvement property is the new classification from what everybody always thought of as leasehold improvements. So traditionally, leasehold improvements were 15-year property, eligible for bonus depreciation, and all was right with the world. Then with the Tax Reform Act, Tax Cut and Jobs Act passed in 17, effective in 18, we've talked about this a lot, so forgive me if you've heard this all before. They added they consolidated the leasehold improvements. There used to be 3 different classes. They consolidated them into this one class called qualified improvement property. You'll note in there's leasehold is not mentioned anywhere in the definition of it. It's just improvements to real property. It has to be non-residential real property, and it has to be an improvement to the property after the property is first placed in service. And so they added this classification. The problem was they forgot to specify it as 15-year property. And so by definition, then under the code, it just gets lumped in with non-residential real property, which means it's 39-year property. So that was a big problem. Obviously, no one was getting along in Washington from 2017 through today, really. So no one, there was just no effort or whatever to fix it, to get it back to that 15-year property. But with the CARES Act, they could all get on the same page and said, hey, we're putting this act together. Why don't we throw this in there? So they changed. Go ahead.
So Mark, basically you're saying it takes a pandemic in order to get people to get along and pass something that should have been passed 2 years ago.
Exactly. Yes. There's also talk in the next stimulus bill of building a new FBI building, including that in the bill, but whatever. So yeah, they changed 39-year property to 15-year property, which was great. That's good. It's what it should have been all along. Problem is now, we've already had 1, possibly 2 tax years filed as 39-year property. So this just creates a host of issues with trying to go backwards, recalculate this to 15-year property. Are you going to take this for bonus? Original thought was like, oh, not a big deal. It's 39-year to 15-year property. And if you're changing it to 15-year property, you just take bonus on it. So, fine, go away. Oh, but a lot of states don't allow bonus depreciation, or they have a different calculation of bonus depreciation. So we said, okay, fine. Well, then I guess it's just do nothing for state, no change, right? Wrong. If you're using 39 years for qualified improvement property, then you have an improper method. You are not taking the appropriate amount of depreciation, which can cause a host of problems on the back end when you try to sell that property. So you not only have to change your federal return, you have to change your state return. If you file in a whole bunch of different states, you're going to have a different calculation in many of those states. So this was a good tax answer, but was created a lot of complications. So in the qualified improvement property, like I said, it's just non-residential real property. and has to be placed in service after the building itself was originally placed in service, there's some wiggle room there on that definition, but that's kind of the high level overview of that.
Yeah, that's a great point, Mark, about how to make that change then as well, because I know for federal, we had some guidance on that where you can either amend, you can file a 3115 and go that route. But then, at times, what do you do for state then? If you amend, that's one thing. You could amend the state return as well, I would imagine. But if you file a 3115, what do you do for the state at that point?
And that's that's another big problem. States that, as we were talking about before, the conformity to the federal code fixed the rolling. If your state starts with federal taxable income, you would use your taxable income after the method change, and then there's a line somewhere on the return to adjust for state depreciation. You would do it that way. But if they don't start with federal taxable income, presumably you'd have to have a state-specific method change to get your depreciation corrected.
Makes sense. And I think you just hit it on the head there as far as, some states allow bonus, some don't. So in general, we know what the rules are on this. It's more how to conform to them and how to actually make it work.
But to clarify, it doesn't make any sense, Lindsay.
Fair enough. Well, then we'll move on. So our next topic there is NOL changes. So generally the federal legislation, and you can add to this, Mark, but 2018 to 2020, the NOLs can be carried back 5 years and losses can be carried forward to 2019 or 2020, offset 100% of taxable income. That's after the CARES Act. So before the CARES Act, there was some changes to NOLs before that, and basically they were, what was the rule before, Mark? It was 20 years forward, and
carry forward 20, you could carry it back 2, and so in the Tax Cuts and Jobs Act, they changed that, so got rid of the NOL carryback, and said you could only carry it forward, but you could carry it forward indefinitely, and you could only offset 80% of taxable income. There's a couple other details in there as well. But then the CARES Act, it is very interesting. The CARES Act came in, and if you read the CARES Act, it talks about the NOL, changes to this NOL now adding back in this 5-year carryback, which, it's kind of funny. When the Tax Cuts and Jobs Act was written, they eliminated NOL carrybacks in this booming economy. Everything was just plowing forward, and it's like, who's going to use an NOL carryback anyway, because no one has losses. And then obviously the pandemic hits, CARES Act comes in and is looking at this in hindsight, and it's like, well, that was a really bad idea. So let's throw this NOL carryback back in there. And if you read the CARES Act, it's included specifically under the business tax portion of the CARES Act. However, if you look at the Internal Revenue Code, there is no difference between business and net operating losses and individual net operating losses. So then by default, this change to the NOL applied to both businesses and individuals. So that was kind of the transition from pre-Tax Cuts and Jobs Act, impact of the Tax Cuts and Jobs Act, to then what the CARES Act implemented.
And then on the state side of things, at least for Pennsylvania, luckily we didn't have to worry about this too much because Pennsylvania had their own rules in place. Basically, we had this Nextel case a couple of years ago, and the issue was that before this Nextel case, you had PA would allow either a percentage limitation on your NOL or up to $5 million. And so that was, for most businesses, you didn't have more than $5 million in NOL. So really, you could just take the full NOL for PA. This case comes along, and Nextel argues that basically for the PA Constitution, you cannot have more than one class of taxation on different people. So it said that applying a percentage to some people and applying a dollar limitation to others really wasn't fair because you were creating two classes of taxpayers. Well, in order to, the logical solution might be just to have that dollar cap, because that's what most people fell under anyway. But instead of doing that, they decided to instead go with the percentage limitation, which means a lot of people that did not have a PA NOL that was limited before, now it's limited because you're limited to a certain amount. And then that changes throughout the years. I think it was 30% for 2018, and for 2019 it was 40%. I believe that's what it is going forward. But long story short, these changes then to the Federal CARES Act really don't affect Pennsylvania, because they already have their own set of rules. Now, Philadelphia as well has stated they do not conform to the federal treatment of the NOLs for BERT tax, the business income and receipts tax, because they allow just a 3-year carry forward. So they have their own rules as well. As far as other states, you would just have to see what their guidance is, because again, this is something where the states are free to issue their own guidance, but it does go back to the conformity to the federal code if there is no guidance issued. Anything to add, Mark?
And the reason I had brought up the individual, that it applied to individuals too, is Pennsylvania has no individual net operating loss. It just goes away. Can't carry it back, can't carry it forward, can't offset a different class of income with it. So it's just gone. Sorry.
Yep. All right, and then finally, we just have a little bit on the interest limitation. So 163J, basically your interest expense could be limited. Do you want to kind of talk about that at the federal level, Mark, before I go into states?
Yeah, the details of this are beyond the scope of this course, but basically they just said if you have interest expense that exceeds 30% of your adjusted taxable income, we're just going to disallow it. Not permanently, it'll just be carried forward. The CARES Act increased that 30% to 50%, and just added some more niceties to make it not terrible in these first couple years, because obviously companies that were doing well in 2019, what did a lot of them do? They expanded, they increased their capex, they put in new machinery lines and everything else because they were ramping up for increased demand. So they in many cases, took on a lot of debt to do that. They have a lot of interest expense now. Economy falls off a cliff. They're now on a loss. Are they just going to get crushed by this? A lot of them would have, but for these changes that they put in there for the CARES Act. So it did lessen the negative impact of the interest expense limitation.
Now, on the state side, we did actually get some decent guidance from PA. They issued a corporate tax bulletin 2019-03. That was on April 29th, 2019. And that was clarifying the original rules on 163J and how those applied to PA. One of those rules being that if corporate net income taxpayers were not required to calculate a limitation unless they were required to calculate that limitation at the federal level. So basically that said, if you don't have a federal interest limitation, you do not need to calculate one just for PA. So there has not been guidance that we have found about specifically the CARES Act updating the 163J rules. I would say it can probably be presumed that they would be the same as the previous guidance and PA would follow those amounts, but PA, one of the things was they did have their own separate carry forward calculation if you were subject to the limitation. So I'd imagine that would still be true. And basically they would just update as far as, following the federal or not. All right, so we'll move on to the next slide then. And we don't want to talk too much about this because there have been several webinars on it and, you could talk all day. I'm sure Mark could talk all week about it. But the PPP loans is our next topic. Do you want to go ahead and talk about that, Mark?
Yeah, so as we've discussed before, the loan forgiveness, if you take the loan and then get it forgiven, that's not taxable. But by definition, under the Internal Revenue Code, the expenses that are paid with tax-exempt income are not deductible. So you're right back in the same position. There is legislation out there, bipartisan legislation that's just been sitting there. I'm not quite sure what the problem is because everybody kind of agrees. Well, the idea was that it shouldn't create a tax liability, but right now it would create a tax liability. So hopefully that'll pass, and then the expenses will be deductible and you will kind of get that double dip effect, but we're still waiting to see.
Yeah, and as far as the state side, you really don't have much guidance on this. As it says there, about 20 states are taxable, but that's only due to conformity and the fact that they have rolling conformity, so automatically they're following what the federal does. One interesting one is North Carolina, because as you mentioned, Mark, the federal, they've said it is, the forgiveness is not going to be taxable, but then the expenses aren't deductible. I believe there's legislation out there that could potentially make those expenses deductible. And North Carolina has come out and said that even if those expenses are made deductible, they're going to consider them not deductible, even if the federal changes it.
What's North Carolina's problem?
It's me. All right, and then just something to mention, there is a lot of other state and local relief available as well. And that is something we'd be happy to assist with if it is something you're interested in, but we're not going to spend time today talking about that unless you wanted to talk about the marketplace loans, Mark.
Yeah, that's Pennsylvania has had a couple now very targeted relief items out there. The one is the marketplace revitalization grants. Those are for smaller employers with 25 employees or less. So again, very targeted. And then just last week they put out hazard pay grants and put the guidance out there to apply. It's targeted to specific industries, food service, food distribution, healthcare, a couple of others. So check that out. If you have questions, as Lindsey mentioned, please feel free to contact us. All right, we are coming to our first polling question. So everybody that is in this for CPE, time to pay attention. If you've zoned out, it's time. Ding, 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 ding. All right, Lindsey, so which of the following is Pennsylvania's only town? Town being the key word in that question. Well, Mark, I wrote these polling questions, so that is for you to guess. So, I've lived in Pennsylvania my entire life. I did not know that there were any towns in Pennsylvania, which is, I guess, what makes this question appropriate, and the fact that there's only one. We've got townships, we've got boroughs, we've got cities, but I didn't know we had any towns. So I know Lancaster's a city. I know Harrisburg's a city. So I'm going to narrow it down to Gettysburg and Bloomsburg. After that, it's just a toss-up. All right, I'll give you a hint. I am biased to places where we have offices. So if you haven't answered this question yet. Oh, so there you go. All right, got about 3 seconds. Yes, so if you were paying attention, I already ruled out one for you. There we go. Oh, look at that. All right, we did get close. The correct answer is Bloomsburg. It is the only incorporated town in PA. Well done. Well done. And I added here as well, everywhere else is either a city, borough, or township. So there is only one town. So there's your first fun fact for the day. All right, so in keeping mode with Pennsylvania, generally this webinar is one where we go over the PA budget and we talk about the different tax provisions and what we see going forward. And we really can't do that this year. And it's not because the budget wasn't passed, but it's simply because there were no tax provisions. So it actually was an interim budget that was passed because of the COVID-19 pandemic. It was decided to just do a 5-month budget just to keep things moving forward. So they will have to pass something else going forward. As of May 26th, the state was projected to lose nearly $5 billion in revenue through June 2021. So I'm curious what those numbers will look like as we go through the year, as this year keeps progressing as none of us would have anticipated. But in general, the budget was enacted. There really aren't any tax items, and there will have to be more work done again once those 5 months are up. It's almost like they had bigger things to worry about. It's amazing how fast that a budget can be passed when there are other things to worry about. Yeah, when you have to get it done. Yeah. Yeah. All right, so then I just wanted to give a few updates specific to Pennsylvania, and these are mostly COVID-related updates. So first of all, income tax. The deadlines followed federal, so most of Pennsylvania's deadlines were extended to July 15th. So that includes personal, that includes corporate,
That also includes partnerships and S corporations. All of the deadlines, along with the payment, were extended to July 15th. And that includes estimated payments as well. And the corporate, I think I misspoke there, corporate is actually due August 14th because the corporate is generally a month later. On the sales tax side of things, PA came out and said that they would postpone the prepayments. Basically, if you have a certain amount of sales tax due, you have to pay half of the tax for the same month last year. So basically, if I get to this July, I have to look at July 2019 and pay half of the sales tax that I paid in July 2019. So you're basing it off of the previous year, the same month. Basically, when COVID hit, PA came out and said those prepayments were not required, and that ended up being through March, April, May, and June. And those did start up again for July. So now we are back on a normal sales tax schedule, normal rules, and prepayments do apply. Now, the logic behind that is pretty simple. Basically, if you made a bunch of income in 2019, there's a pretty good chance you're not making the same amount of income in 2020, especially if you were a business that was shut down. So really just the state trying to grant some relief on that. Business tax licenses. So basically, those are just extended until further notice. And this includes things like sales and use tax licenses and sales tax exemption certificates for nonprofits, among other things. So we'll have to wait and see when the state lifts those rules. But for right now, all of that is postponed. And same thing with the department notices. If you received a notice that has a due date on it, during this whole pandemic, that due date for that notice is extended until the department comes out and says you have to respond. Who knows when that will be?
Yeah, that is, we obviously, because of all this, the state's overwhelmed. Department of Revenue employees have been shifted over to unemployment compensation if they're not just sent home to work from home. I think, some of them are coming back. But, imagine going on vacation for, I'm not suggesting anyone was on a vacation, but imagine going on a vacation and stopping your mail, for 3 months and then coming back and 3 months worth of mail is delivered. That's essentially what they're facing. So they've taken the right steps here to kind of delay all this stuff. So that's the positive side of it. The downside is, particularly on the unemployment compensation side, the system is just completely overwhelmed. It was never meant to deal with this kind of volume, let alone during a time when everyone's working from home. So it'll be interesting to see they will have to get back up to speed at some point, but how long is this going to take to get through the backlog? Nobody knows.
Yeah, and PA, among many other states, I think you're going to have to see, you will see a lot of leniency, I would think, as far as enforcing taxes and rules, just because, the states generally want to work with taxpayers. Everybody wants to be at a good, compliant place. So, I would imagine PA is going to try their best to catch up and to work with taxpayers. I was just on a webinar with the Philadelphia department this morning. And they actually said right now is a great time to get in compliance if you aren't, because they have the resources right now and they really ramped up. And they said their phone calls were 1 minute wait time, 2 minutes at peak time. So it's quite impressive.
Yeah,
but
I'd say so.
Yeah, I imagine that's not everybody, but it'll be interesting to see when this all kind of starts to get back to normal.
Yeah, we would encourage you to call the state on a lot of these things, because like Lindsey mentioned, our sense is that they are going to have a lot of leniency. The most notices are computer generated now. They may never actually see a person, and are all the computer systems for Pennsylvania and all the other states, are they updated to reflect all of these due date changes? Maybe, maybe not. And if they're not correctly updated, it's just going to generate a notice and go out to you. But call them, and pretty much, the Internal Revenue Code has it. Pretty much every state tax code has it, where if you have reasonable cause to get out of a penalty, then they can grant that reasonable cause. I can't think of a more appropriate reasonable cause than a pandemic. So while we've heard of no blanket exemptions from penalties, I think you have a good case to get out of it.
Yep, agreed. I think we kind of already covered this then, but I put the PA economic forecast on there. It's interesting. PA does release the economic forecast, or I'm sorry, I'm not sure that's PA. It's the U.S. Bureau of Economics and Bureau of Labor Statistics releases these, and it was actually showing. I believe this was released around June, but it's showing, the difference between 2019 and 2020. You've got like the difference in GDP and wages and salaries. And PA was actually projecting as better than the U.S. economic forecast in June. Now, there were some assumptions in that report that basically said a second outbreak doesn't occur and schools and colleges reopen in the fall. So who knows what might happen, honestly, at this point, because obviously those assumptions may or may not prove true. All right, and this is something I always like to have in our webinar here, just showing how PA compares to other states in relation to taxation. Right here we have the State Business Climate Index, which ranks states based on 5 different types of taxes. You got corporate tax, individual, sales tax, property tax, and I believe unemployment insurance. And this, you can see the blue states there are the ones that are highest ranked. Most of those states are ones that don't have at least one of these. So you've got like the states that don't actually have a sales tax on there. You can see Montana, Oregon. And then you've got the states like Florida that don't have an income tax. But a lot of times the ones that are ranked the best, it's because they don't have one of those factors. And so, of course, it's the best ranking. On the flip side, you see the states in the dark gray there that are the worst ranked states. And Pennsylvania is not one of those, but you can see what it's surrounded by. So if you believe there's any influence from the states around us, you can kind of see we have number 49 and 50 there with New York and New Jersey as the worst taxation states for business tax climate. One thing I think is interesting as well, like last year, if you look at this chart that I had in the webinar, it had Pennsylvania's overall rank as 34. So based on that, you have 29 here. It looks like it went up quite a bit, but the index does actually change the way that it ranks these. It changes the weight on each of the rankings. So corporate tax rate might be worth more or less than it was last year, and that'll actually change the ranking. So looking at the different types of taxes, PA really didn't change a lot. They got better in a few areas, but it seems to be more that it's due to the other states making changes versus PA making changes.
I would be curious to know how they do their calculations and how the corporate rank weighs in there, because while Pennsylvania has one of the highest corporate income tax rates in the country, so few companies are actually C corporations, and so few actually pay income tax relative to the number of pass-throughs, which ultimately end up at individuals. And PA has such a low individual tax rate. Throw on there how Pennsylvania doesn't tax retirement income. I always struggle to see how we rank so low.
Yeah, that's fair. I mean, you certainly have states that have, no personal income tax, but right, 19 is pretty high. I mean, if anything, I would have to say maybe the difficulty of it, because you have those 7 buckets of income and you don't necessarily start with federal income, because I believe this does take into account how complicated it is for someone to comply with the rules. So maybe that's part of it. It's hard to say. I can send you the whole report if you want.
That's okay.
Some light reading, help you sleep. All right. Working from home, this has been quite a hot topic. We've had some clients ask us about this. So basically, we're all working from home, right? Or at least most people were at one point if they had the capability. So what happens then when it comes to Nexus? Because even before Wayfair, if you had somebody sitting in a state, that generally made you have nexus in that state, and that, could trigger all these different filings. So what happens now that we have so many people working from home? Is it going to mean that we're going to have a lot more filings in states this year? Well, we've got, surprisingly, there's only 16 states that have issued guidance on this, saying that an employee working from home due to COVID would not cause a nexus. It's hard to say whether we might see more guidance from that, as many employees that are working from home, especially like in Pennsylvania, I know mine's voluntary. I could go into an office if I wanted to. Some states say if that's the case and you have the option, then you have to be taxed. The other question is, even for these states that do have guidance saying that an employee working from home doesn't cause nexus, how long does that last? Because if it's only due to COVID, does it last as long as there's an emergency order? Does it last up to a specified date, or does it last, is it just if the employee is actually affected by COVID where they were exposed or could have been exposed and have to self-quarantine? So there's a lot of things to consider, even when there are states that have guidance. The other issue to check specifically for withholding is if a state has reciprocity with Pennsylvania. So I believe Maryland, for example, is it Maryland? Maybe it's New Jersey. One of them has reciprocity with Pennsylvania, which means even if the employee is in New Jersey, you can withhold PA taxes. So the other, Philadelphia, I wanted to mention as well, has stated that they've temporarily waived their legal nexus threshold that states with employees working temporarily from home in Philadelphia as establishing nexus is going to be waived for right now. So basically, if you have an employee that is working from home, that the business is not in Philadelphia, but the employee is sitting at home in Philadelphia, temporarily that will not cause nexus for Philadelphia purposes. But that is a temporary thing, so they can decide when. You'll have to look out for when that will end, because at some point having that employee sitting in Philadelphia will cause nexus. I actually did also find for Pennsylvania, they haven't issued specific guidance, but on their customer service site, there are some questions on this, and they've stated that if a company has an employee working from home temporarily as a result of COVID, the state will not seek to impose either corporate net income tax or sales and use tax only because you have an employee sitting in Pennsylvania. Now, I'm guessing that's probably not relevant to most people listening to this webinar now, since we're in Pennsylvania, and obviously if you're in Pennsylvania already, you have nexus. But if it were an out-of-state company that has just, say one Pennsylvania employee that's working from home due to COVID, they would potentially not have nexus because of that. So that's something to look out for in other states. As I mentioned, there are some that have issued guidance, but just be cautious, because if you do have an employee working from home, you may have triggered some sort of nexus issue. All right, and just to note as well, nexus, I have there listed a couple of types, because you really have to consider a lot when you might have nexus, because you could have withholding requirements, you could have income tax nexus where you have to file an income tax return, you could potentially have to collect sales taxes then as well. And then finally, just on another note, there used to be a federal home office deduction that is no longer allowable, but Pennsylvania does require or does allow a deduction for a home office if you meet all kinds of crazy rules and jump through hoops, right, Mark?
Yeah, it's a fun thing. So the important thing to note here is employee at the federal level. Generally, if you're a W-2 employee, there's no home office deduction available to you at the federal level. There's potential at the PA level, but yeah, like Lindsey said, there's a lot of hoops you got to jump through. You got to make a really strong case that you are using at least a portion of your home almost exclusively for work to get that deduction. If you are an independent contractor, self-employed, then the home office deduction at the federal level is still potentially available to you. But again, there are some stipulations that you have to meet to get that deduction.
All right, and now we come to polling question number 2. So that is, what state imposes a tax on blueberries and has a blueberry tax return.
Why would you tax blueberries?
Well, we will get to that, Mark. There is a reason. Long answer short, because they make money.
Ask a stupid question.
All right, so we give you a little bit more time. Make sure you are answering our polling question.
We should get like a train horn or something to blow.
I know, I need a sound effect here.
Yeah.
All right, about 5 more seconds. Get your questions in if you haven't already.
Look at that.
Okay.
I am impressed with our audience today.
Same here. They got it right. So the answer is Maine. Part of the reason for that is simply because Maine imposes tax on blueberries because they are the main producer of blueberries in the United States. So I believe this is more of a tax on the production of them. I don't know the specifics of it. I can't say I've done any blueberry tax returns. Good job, everybody. All right, and this would not be a state and local tax update if we didn't talk about Wayfair. So for those of you that don't know, Wayfair was one of the biggest change in sales tax for 25 years when it happened in 2018. So I'll give you a little bit of background on that. Basically, before this passed, the rule really came down to if you had physical presence in a state, then you would be required to register, collect, and remit sales taxes in that state. But you really had to have that physical presence. You had to have somebody step foot into the state in order to establish that nexus. So really, if you were just shipping items into the state, then you were safe. Bring in the internet and you've got everybody ordering things where that is the case, where they're ordering from a company located in one state, but then that company is shipping out all over the place. So pre-Wayfair, that company really only had to register and remit tax in the state that they were located in. So it really got companies out of a lot of tax. If you were a company that was shipping things, the customer then, well, I should say the company's customers, because then they didn't have to pay the tax. But for the companies, it was much easier on compliance if you didn't have to register and collect tax in a state. Come Wayfair, you have South Dakota, which enacts this rule that if you have $100,000 in sales and 200 transactions, then you are required to register and collect sales tax. So they basically passed this rule in the hopes that it would be go through the court system, because states were really sick of this whole physical presence thing because they were losing out on a lot of revenue from things being shipped to them. So this did go up to the Supreme Court, and ultimately the Supreme Court made a decision that South Dakota's rule was okay. And there were a lot of reasons that they listed that they came to that decision. But mainly they said they had a reasonable threshold at 100,000 and 200 transactions. And they weren't looking backwards, so they were only going to do this on a go-forward basis, because obviously it wouldn't really be fair if we had to comply to a rule that we didn't know about before. And so it really came down to that, and then other states immediately started following suit. So now we have all these states that have these economic nexus rules, and we'll get to that in a second, what some specific states' limits are. But just a couple things I wanted to mention here is, first of all, just remember, as you're looking into where you may or may not have nexus, physical presence still applies. So regardless of whether you do or don't have $100,000 of sales into a state, if you're physically in that state somehow, you probably still have nexus. So I think that's important, just to not forget that this did not replace the old rules. It's just an added rule on top of it. With that said, economic nexus makes it a lot more important now to consider your tracking of sales by state. because if your company is not tracking your sales into each state, you have no way of knowing whether you may or may not have economic nexus. Sounds easier said than done. I think, you know, for some companies, they probably were already doing this for apportionment purposes or who knows what, but I know we've run into that issue as a CPA firm because we may not receive, if we're only filing in PA for, now this is more income tax, but if we're only filing in PA, we might not receive the sales by state from that client because we've never needed it before because everything is in PA. But this is something that I would have to recommend sending that sales by state to your accountant with your other tax items, or at least reaching out to your accountant if you're thinking you may have nexus, because it's something you do want to become compliant in, because states are going to be looking more and more to enforce these rules, especially with the revenue shortfalls that they're encountering. And I'm sure with COVID, plenty of people are ordering even more online than they were before. So I think we'll see more and more of this economic nexus coming into play with Wayfair. Did I cover everything there, Mark?
I think so. That's a good point about so much more activity being online and everything. And two, but just to remember, this doesn't, a lot of people, when they hear Wayfair, they think, oh, I'm a manufacturer, this doesn't apply to me. It does. It just applies to shipping into a state without having a physical presence there. That's what we're talking about here. It just, Wayfair is the big shiny object that everybody likes to point to.
Yeah, absolutely. And I think we might get into this later, but you also have to consider whether those sales are taxable or non-taxable. You kind of brought up with the manufacturer there. Even if you have sales that generally aren't taxable, there are states that require that their economic nexus rules do not specify that it's taxable sales. So it's possible if you, even if you have non-taxable sales into a state, that could trigger nexus. And then finally, I wanted to, oh, go ahead, Mark.
I was just going to say, in that case, if there's a filing requirement, even if you have, so the number of sales you have determines whether or not you have the filing requirement, whether they're taxable sales or not. So if your liability is zero, your reaction will most likely be, well, why in the world would I file if my liability is zero? Depends on the state's rules. A lot of states just have, if you were supposed to file, I don't care if the answer is zero, if you were supposed to file and you don't, it's $500 penalty. It may not necessarily be based on your tax liability. So that's just one thing to keep in mind, that even if you have no tax liability, there still might be a penalty associated with it.
Yeah, absolutely. There may or may not be. It's hard to say, but if you don't look, you don't know. So you certainly don't want to end up in a situation where you end up having all of these penalties due because you weren't filing zero returns. Now, and then I just wanted to touch as well on marketplace facilitator rules. This is when a state requires what they call a marketplace facilitator to collect tax on behalf of the sales that they're facilitating. So think Amazon, think Etsy, anything that's making sales on behalf of somebody else. A lot of states are saying those entities need to register, and they need to, if Etsy is making a sale on your behalf, they need to collect that tax and remit it. But this is something I think businesses need to be really careful about as well, because if you're that business, you need to make sure you know whether or not Etsy is collecting that sales tax for you, because if you think they are and they're really not, you could really have an issue there. All right, so how have the state limitations changed? I had included a slide last year on what these limitations are, so I wanted to give a little bit of an update on this. As you can see, a vast majority of states, they are South Dakota copycats. So they're following what South Dakota's rule was with the 100,000 in sales and 200 transactions. Now, the and or can be an issue because some states it's an or. So I think that's another thing you might have to be careful about, because if you don't have 100,000 in sales, but you're selling some small items into the state, if you have at least 200 transactions, that could also trigger economic nexus. I don't know how the state would really enforce that. You know, are they keeping track of all the sales, all the transactions you have into their state? I think that'd be a little bit difficult, but
I think they have enough to keep track of already.
But it is in the rules. So I wanted to add as well, there are a few new states that have changed their rules even since last year when they enacted them. You've got like Alaska was added on. Georgia and Massachusetts used to have higher limitations and have now lowered them. My guess for some of those, they probably had those higher limitations before South Dakota was passed, or sorry, before Wayfair happened, and then decided, oh, well, if they're going with 100,000, let's jump on board with that lower threshold. So you've got a few states that have changed their rules, even as recently as Tennessee, which will be changing 10/1/2020. And then you've got those other states as well with a few different limitations. Some are 250,000, some are 500,000, as you can see there. The other thing I wanted to mention before I leave this slide is to consider the sourcing of sales as well, because that can really make a difference. There are a lot of states that are now market-based sourcing, which I think I would consider that to be the standard. Market-based sourcing just means if you are selling, if I'm in PA and I'm selling to Maryland and I'm shipping that item to Maryland, to a customer in Maryland, that is a Maryland sale. It's where the market is, it's where the customer is receiving the benefit. That is opposed to cost of performance, which is where the service is performed. So it can get a little bit tricky, but like if I'm doing something in PA, even if the benefit is ultimately in Maryland, that could be sourced to PA. It just kind of depends what you're doing and where you're doing it, but that's a determination we could always help you make if you're not sure. But that's something to consider as well, because that would determine where you're sourcing your sales for these nexus rules. So that brings us to PL 86272. So this was really a federal protection that was put into place quite a while ago, but it only applies to income tax. And this rule basically says if the only activity you have is soliciting sales in a state and then, you know, shipping sales to that, shipping items or whatever you're selling into that state, a state cannot impose income tax nexus. So basically it was a protection so that states weren't just imposing nexus all over the place, basically, which is what they're doing now. So PL 86272, the issue with that is that it only applies to income taxes, which means if you have a state with a gross receipts tax, a state with a franchise tax, anything that's not considered an income tax, PL 86272 does not apply. So really, you're just free reign with the economic nexus. And I say that because Wayfair is related to sales tax, but now we have a lot of states that are imposing that same economic nexus on other types of taxes, including income tax, which, you know, may or may not fly based on PL 86272, because you've got Hawaii, which is one of the first ones to do this. I haven't heard anything questioning that. Maybe it's because there's just not that many companies that have sales into Hawaii that have bothered with it, but, or, you know, maybe they see filing income tax in Hawaii is just being easier than trying to fight it. But you've got a lot of those other types of taxes here as well. So like Texas franchise, if you have 500,000 in sales, that's something that will need to be filed. Oregon has a new commercial activity tax that will be imposed if you have over 750,000 in tax. And then Pennsylvania also has said that their corporate net income tax would be imposed if you have more than 500,000 in sales. So you've got localities as well that are kind of doing the same thing. So it's not getting any less complicated, basically, because as soon as, you know, ever since Wayfair passed, states are really trying to grab at whatever they can impose. And I gotta say, in a way, maybe it makes a little bit more sense, because, you know, why shouldn't you? It almost makes it a little bit more standard in a way. If everyone is imposing this economic nexus, then, you know, if you know that whenever you sell into a state, if you have 100,000, you're going to have to file there, at least it's a standard.
I would love to say that I could see the feds coming out and applying some sort of standard similar to Public Law 86272, but I don't see it happening.
All right, and then if you look into your economic nexus, your nexus in general, you might find a liability there, and that's where voluntary disclosure agreements come in. So basically, for voluntary disclosure agreements, if you find a liability in a state that you have not been remitting tax in, it can be sales tax, income tax, you are able to voluntarily go to that state and tell them, I want to become compliant, and basically reduce the amount of penalties that you'll have to pay to that state. And that's something that we can help with. Basically, we could contact the state on your behalf, say that we have a client that needs a VDA and would like to become compliant, and we would work with them. We would figure out what your liability might be and work with the state then to help you become compliant. And it's really a good way just to become compliant in a state where otherwise, if they come after you, you're going to have penalties due. All right, and then I have a couple of things there, considering whether you have economic nexus. So I mentioned about the non-taxable sales. You might even want to consider state sourcing, market-based, or cost of performance, and then just your dates. When did you actually hit the threshold? You know, where, because most states go like 3 years back for the statute of limitations, but some of these economic nexus rules weren't enacted until like 2018 or 2019. So you might not have to go back the full 3 years, but we can work with you and determine, you know, the best route forward and if a VDA is right for you. All right, and that brings us to our third and final polling question. So this, I wanted to do more of a poll on this one. I thought I had enough trivia for the night, and I was honestly just curious what everybody found the most interesting, or if you're just in it for the CPE, because let's be honest, I have no issue if you're just in it for the CPE. So what topic do you find the most interesting? We've got COVID-19 stuff, the PA updates and the state comparisons. I know my favorite, the Wayfair and economic nexus, but I'm a little biased as a SALT person.
I was going to say, that's weird if you think that's the most interesting one.
It's interesting. There's so much going on. I mean, how can you not be interested? It's always changing.
Oh, yeah, that's why it's, yeah. I guess taxes.
Although I could do with a little less change. Recently, I could do with a little less change considering, you know, my job keeps changing, but. All right, we'll give you about 5 more seconds. Make sure you answer the polling question if you want CPE. All right.
Ooh.
All right, looks like a pretty even split here, surprisingly.
Yeah.
But people don't agree with me on the Wayfair economic nexus. All right, fair enough. All right. All right, and then finally, to round things out, I just listed a couple of state tax updates here. So these were updates as of July 1st, 2020. So honestly, more so than even just going over these updates, I just want to reiterate that these rules are constantly changing. So it's really something to keep tabs on, because even as of July 1st, with all this COVID stuff going on, there's still states that are passing new sales tax exemptions. So ever changing. And then there's all kinds of stuff going on with vapor and marijuana taxes. I don't get too much into that.
Yeah, that's going to be an interesting one, because that market is really ramping up here, and the feds have made it very clear. The courts have said on medical marijuana, even if it's legal in the state, it's illegal at the federal level, which means you can only deduct your cost of goods sold. Your general and admin expenses, they are non-deductible for tax purposes at the federal level.
Sounds like it'd make it pretty complicated.
Yeah. So we're just about at the end here. We did have one question come in on the PPP loans that I want to address quick. So the question is it possible that you could have the expenses not deductible in 2019 and then the forgiveness not taxable in 2020, so they don't match in tax years with the new forgiveness guidance? Cash flow, yeah, your expenses are going to all be out the door in 2019. They have to be under the CARES Act and under the rules of the PPP loans. So all of your cash would be out the door. Your expenses would be booked, whether you're accrual or cash basis. The forgiveness would not happen until, or the income event would not happen until the loan is actually forgiven. So it is possible that you would have income in 2020 that's not taxable and the expenses in 19. But on your 19 return, if that happened, your loan would still be considered a loan. It wouldn't have been forgiven yet, so it's not income, so you can still deduct those expenses in 19. And then in 2020, I would think the appropriate way to handle it would be you would have book income for the forgiveness of the loan and a favorable adjustment to remove that income for tax, but then you would have an unfavorable adjustment equal to the expenses that were paid with that forgiven loan in 2019. So from a tax perspective, I think they'll always match up within the tax year. So I don't think you'd have a thing where it would cross tax years from tax impact.
And then we do have one other question here that came in regarding Wayfair. I'm in PA. The company I sell to is in Missouri, and we ship to California. What state collects the tax? That's a great question, and it relates to what we call drop shipping. So it's where your customer is in one state, but you're shipping it to their customer in another state. And each state does have different rules on that. So you would have to go to the specific rules for Missouri and for California, and then on top of that, determine whether you have nexus in those states. So, I mean, that's something I'd be happy to assist with if you want to reach out to me directly, but we would have to look at the specific rules for those states on drop shipping. All right, so on behalf of Macaulay and Asbury, I think we're at the end of our time here. Thank you for joining us today at this webinar. If you have any further questions regarding today's presentation, please feel free to reach out to one of us and we'd be happy to assist. A recap of today's presentation will be posted on our website in a few days. And for those of you who need CPE, hopefully you answered the questions. Those certificates will be sent out within the next 2 weeks. Thanks again for joining us and have a great rest of your week.